Okay, good afternoon to all of you. Today we are going to discuss the taxation, tax liability of clubs, trade associations, and the charitable institutions. Up to now, we have already uh, discussed the different sources of income and individual tax calculation as well as the company tax calculations. So apart from this, these are some of the miscellaneous tax calculation institutions we are going to look at today. So first one would be the club. A club is an association of two or more people united by a common interest or a goal. So in that case, we are going to look at it as the club. The club is chargeable for income tax as a body of person under Section 2 of Inland Revenue Department. So in the first day itself, we have discussed what you mean by a body of person, because under Section 2, that is called the charging section, we identify the different persons who are liable to pay income tax as an individual, as a company, as a body of person, as a government, likewise. So the club we are going to tax under the body of person. The provision on residential status of a club is similar to that of a company in terms of Section 79, subsection 1 of the Act. So I think you are very much aware on that how we are going to decide the residential status of the company as well as the individuals. So for the clubs, we are going to decide the residential status based on the company terms. So the company, we are going to decide the residential status based on two criteria. First one is whether that company registered in Sri Lanka, or the management controls is done in Sri Lanka, key management functions. So in that case, we are going to decide it as a the resident company. If not, we are going to classify it as a non-resident company. So having that, we are going to mainly identify two bases for taxation of a club. So mainly we are going to identify the business income, and then we are going to identify the investment income. So these are the two main concerns on the taxation of club. So when you are calculating the income tax liability for a club, we have to decide whether that institute carried out their activities during the year of assessment. So when a body of person, now we are going to classify it as a body of person, whether corporate or otherwise carries on club or similar institution, income tax liability to be decided as follows. First step is to decide whether club is carrying on a business or not. So each and every year of assessment, we have to decide whether that particular club has been carrying out the businesses during the year of assessment. Then in deciding whether a club is carrying on a business or not, receipts from members is the main criteria. Okay. So we have to take out of total receipts how much we have received from the members. Then we are going to take it as a percentage. So based on that, we are going to decide whether they have done the business activities during the year of assessment or not. So to decide the club is deemed to be carried on a business, so this would be the criteria, where less than 3/4 of its gross receipt of the club are from members, it shall be deemed to be carried on a business. That means receipt from members out of the total receipt during the year of assessment is less than the 75%. We decide they are doing the business activities during the year of assessment. If so, whole of the income arising from transactions both with members and others, including entrance fees, subscription, shall be deemed to be receipt from business. Okay, so that means we are going to consider the total receipts including subscriptions and the entrance fees, it as a business receipt. If they are doing the business activities during the year of assessment, then it is liable to tax on both its business profits and investment income. Because at the initial stage we identified that for the club taxation of club we are going to identify the main two income criteria. First one is the business income, the second one is the investment income. Before calculating the tax liability, we have to decide whether that club has been carried out the business during the year of assessment or not. So in order to decide that, we have to take the receipt from members. Normally entrance fees, subscriptions, donations, members donations. So these are the receipts from members. Out of its total receipts, we are going to calculate how much it comprises. So if it is less than 75%, we decide that that club has been carried out the business during the year of assessment. In that case, we are going to consider the members' receipts like entrance fees, subscription as a part of their business receipts. So if that business, the club has carried out the business during the year of assessment, club need to pay taxes on both its business income as well as investment income. The second one is the club does not carry out the business during the year of assessment, where more than 3/4 of gross receipts of a club are from members, it shall be deemed not to carry out the business. That means if it is, the percentage is more than 75%, we decide that the club does not carrying out the business during that particular year of assessment. In such a case, the club is chargeable with the income tax only on its investment income. So investment income normally classified under the investment income we are going to categorize the income from property, interest income, dividend income. Likewise, the different sources of income we are having, you have already discussed those different sources. So these sources we are going to classify it as the investment income. And finally, if we are going based on the either investment income or business income, we are going to charge the rate of 10% tax. Okay. So, especially when we are calculating the taxes for these clubs, there are some of the exemption income sources. I think under the special cases you have studied some of these special cases. So especially particular to the sports clubs, the NAV, that is net annual value of any land and improvements owned or occupied by sports club, is exempted from income tax. So that means that the club has carried out the main activities to promote the business, the sports. So the club which are owned by any kind of property, the net annual value would be exempted from the income tax. So normally sports club must meet the following conditions. The primary object of which is the promotion of any sports which is recognized as sport for purposes of the sports law number 25 of 1973 and used for that object by that body, and it should be constructed after 1st April 2008. That means that property should be constructed after 1st April 2008, and that club carrying out the business activities purely for the promotion of the sports. So normally how we are going to calculate the net annual value of the property? So because you have to first identify the net annual value. If it is purely for the promoting the sports, then it will be exempted. So how we are going to calculate the net annual value? A rating assessment from, you have to claim 25%, then you are arriving with the what net annual value. It will however be liable to any income tax from letting of the premises. That means if the sports club use their property for purely for their activities, then it will be exempted. If not, if they are going to rent it out to another person, they are definitely liable to pay income tax on which source? Under the rent income. Okay. Example. Yeah, provide the income and expenditure accounts for Looney Cricket Club for year ended 31st March 2016 as follows. You are required to determine whether the club is carrying a business as per the Inland Revenue Act and compute the income tax liability of the club. Okay, normally the clubs and the trade associations, they are not that much bothered about the preparing the income statements. Just they are having the income and the expenditure details. So we normally call it as the incomplete the record. So based on that, they're going to identify what would be the surplus or deficit. So according to this Looney Cricket Club, for this year of assessment, they have calculated this income and expenditure account. So they are having the opening balance, some of the income sources as well as the expenditure as well as the closing cash and bank balance. So before calculating the tax for this particular Looney club, you have to decide first what? You have to decide whether the club has been carried out the business during the year of assessment or not. So in order to decide that, you have to take the receipt from members. Then you are going to compare it with the total receipts of the Looney Cricket Club. So what would be the receipt from the members? So first step is to identify whether the club is carrying a business or not. In order to decide, you have to take as a percentage what would be the receipt from members against its total receipts. So receipt from members, normally entrance fees, subscriptions and the donations. Even donation, if it is from members, you are going to classify it as a receipt from members. So out of that, 235,000 is from members. Then you have to take it from during the year of assessment, out of total receipts, how much would be from the members. So how much would be the total receipts? 760,000 would be the total receipt, but opening balance is there 80,000. It is not during this year of assessment, so you have to eliminate that 80,000. Then you have to take the net total receipt during the year of assessment. Then calculate the percentage. What would be the receipts during the year of assessment? Total receipts is 680,000. Receipt from members 235,000. So our decision criteria is to 75% of the total receipts. Okay, the total 75% of the total receipts is amounting to 498,750. But at the moment, the total receipts from members is less than 75,000. So our decision is what? It is around 34%. 35% roughly. So what is our decision whether that club has been carrying out the business or not? They have done the business during the year of assessment. So that actual receipt from members is therefore less than 3/4 of the total receipt. So business is carrying out the business during that year of assessment. That means you have to pay taxes, both business income as well as investment income. So first we look at to calculate the business income. Now we are very much familiarized with the business income tax calculation. So in that case what you have to do, you have to consider what things, especially for you have studied the trade, business, profession or vocation, a separate source of income. So in that case you have to consider what? Especially you have to consider special 2 sections you have to be referred. What are those 2 sections? Any idea? Online students? Even for the individual tax calculation, even for the company tax, even for the clubs, trade associations, you have to refer that in order to calculate the business income, you have to refer that sections. Section 25 and section 26. Section 25 deals with what? Allowable expenses. That means when we arrive, normally the financial reports shows the accounting profit, but we are not going to charge the taxes as it is. We are going to convert it tax adjusted profit. In that case, you have to deduct some of the allowed expenses under the Inland Revenue Department or the Act, then add back some of the disallowed expenses. So these are the 2 sections. Section 25 deals with the allowable expenses. Section 26 deals with the disallowable expenses. So same thing applicable for these clubs as well in order to calculate the business profit. Okay. So just can you calculate the profit? It's a small question. First you have to calculate, you have to identify the profit. Normally individuals or even the companies, you can straight away you can take the profit for the year, but in this case under the income and expenditure account you just only have the cash and bank balance. So you have to take it as a profit by removing the opening balance, because it has an opening balance how much? 80,000 and closing balance is 303,000. The net balance would be we have to take it as a return for the period. Okay, so that would be the profit for the year of that particular year of assessment. For that adjustments you have, for that profit you have to adjust the allowable and the disallowable things, you have to separately identify, then you have to calculate the business profit. So entrance fees, subscriptions, donation from non-members, interest, gross means it is not withholding tax deducted interest income. rent income, bar sales, profit from musical show. These are their income sources. And the expenditure, staff salaries, electricity and water rates, purchase of computer, printing and stationery, telephones, audit fees, donation to home for elders, entertainment, and closing cash and bank balance. Okay, the profit is 425. Okay, just look at that one because you have to calculate the profits. So the whatever the consider the item, same application is applicable for the even the individual or the company taxation. That's why I have request to calculate this business income. So profit is around 223,000 based on the net of the cash balances. Then so you have to add disallowable expenses. That means we are not allowed to deduct. So donations, we are not allowed to. The expenses means that we have incurred these cash outflows. We have done the donations worth of 100,000, but according to section 25, we are not allowed to deduct for these donations. So you have to add back. Then entertainment, are we allowed to deduct? No, so you have to add back say 65,000. Purchase of computer, are we allowed to deduct? No, because it is a capital expenditure. So you are not allowed to deduct because we have to claim the capital allowances on this purchase of computer. And rates. Rate is relating to the, because at the income side we can identify there is a rent income. So we have to pay the rates on that rent income. It is 500,000. Again, we cannot consider it as our business activities because it is a separate source of income. Then we are going to already to our income we have considered which are not considering as a business receipts. So when you are calculating the tax adjusted business profit, you have to eliminate the non-business receipts. Okay, so these are the non-business receipts because donations from members is not a business receipt. You have to eliminate that one. It is already included in our profit. And donation from non-members even it is not a business receipt. And the interest income, it is not a business receipt because it is a separate source of income. And rent income also, it is not a business receipt. Again, it is a separate source of income under the property income. Then you have to claim the capital allowances on computer. What would be the rate? 25% you can claim capital allowances. So according to this example, these are the only things you have to consider when you arrive in the business profit, because apart from these all others are allowable expenses. Okay, bar sales and the profit from musical show. In order to generate the revenue, they have done these activities. And entrance fees and subscription, I have mentioned that if the business is, if the club is carrying out the business, you are going to consider the entrance fees and the subscription from members is a part of business receipt. So in that case, we are going to consider it as a business receipt. You are not going to eliminate this business, the entrance fees and the subscriptions. Other things are not related to our business income. We have eliminate those things. In this right, expenditure sides, salaries, electricity are incurred for the production of income. Rates and computer we have eliminated already. Printing and stationery, telephone, audit fees, it is already incurred for the production of income. Donation to home elders, it is not a allowable expense, that's why we have add back it. And entertainment also, it is a disallowable expenses, so you have to add back. Okay, so accordingly our profit from business is 85,500. Then you have to calculate, because now club is carrying out their business, so they have to pay income tax on what? Both business income and the investment income. Next is you have to calculate the investment income. So can you identify the different investments they have done? Okay, according to the income and expenditure account, what are the different investments they have done? They receive the income from interest and rent. Okay, income from interest 10,000, because they have mentioned that it is a gross interest income. You need not to adjust any of this 10,000. Then second one would be rent income 78,750. How it has come? How we are going to calculate the rent income? How we are going to calculate the rent income? Any idea? You have to take the gross rent receipt. From that you have to deduct rates paid by the owner. Then you have to claim 25% on repair and maintenance. Gross rent is 110,000. Now, because that's why the club has paid that 5,000 rates. That's why they have deducted. So if the club does not pay that 500,000, can we claim? No, we cannot claim even it has an expense. Then from the net, 25% you have to claim, and it would be 78,750. Okay, these are the only two investment income sources of that particular Looney Cricket Club. Then we are going to calculate the income tax, so that total investment income is 88,750, because rent income plus interest income. Then business income is 85,500. Then we call it as a total statutory income. After that, what will happen? Total statutory, because total statutory income means normally the sources we call it as a statutory sources. Up to now you have discussed employment income, interest income, dividend income, property income, trade, business, profession or vocation. Likewise, different sources you have studied. We call it as a statutory sources. So any individual or a company or a club is relating to any of whatever the income sources, we call it as a statutory sources. You are going to get the aggregation of these total sources, different sources. We call it as the total value, we call it as a total statutory income. Then you are going to calculate one. After that, Straight away are we going to calculate the taxes? Because you have to follow these steps. Whatever the individuals, companies or trade associations or charitable institutions, same formula you have to follow. Out of total statutory income, especially for the individuals, you can make some adjustment. That is, if that individual has a child below 18 years, so you are going to add that individual, the child income, to that particular person's income. So after that you are going to take the aggregated total statutory income. If not, it is only for the individuals. Then after that you are going to calculate what? Assessable income. When you are calculating the assessable income, you have to consider two things. What are those? Income not form part of assessable income and section 32. Okay. Income not form part of assessable income means what? If the total statutory income include, in any case, already final tax payment sources are there. So we are not going to further tax on that. So in that case, we are going to eliminate it from this total statutory income. Like withholding tax deducted, interest income, dividend income, lottery winning likewise, you have to eliminate those things. Then section 32 means what? You can identify different areas, interest and royalty, the interest and the what called annuities. Okay, ground rent now you can deduct it when you are calculating the business income, but earlier it is under the section 32, but not now. And business losses as well as pre-commencement expenses you can claim. So that would be the section 32. After that you are arriving assessable income. Then you have to deduct the under section 34, that is called the qualifying payments. So for the individuals, especially tax-free allowance of 500,000 you can claim, but for the companies it is not only for the individuals but for the charitable institutions as well. They can claim this 500,000 tax-free allowance. So after that you are arriving the taxable income. So for this loony cricket graph, can you calculate the taxable income by following these steps? You have to check, are there any, up to now we have calculated the total statutory income. Then you have to consider two areas to calculate the assessable income, that is income not form part of assessable income, and the section 32. Is there any expenses or the claims? If not, nil. Then calculate the taxable income. Just can you calculate the taxable income? 0. Just again look at, is there any expenses or the claims? Nothing. Okay. Deduction not form part of assessable income? No. Because interest income as well, it is not interest withholding tax deducted. Under section 32? No. So that assessable income is same as it is. Then you are going to calculate what? Taxable income. When you are calculating the taxable income, you have to claim the qualifying payments. Are there any qualifying payments here? No. Donation for approved charity. They have done 100,000 donations. So that how we are going to claim that one? Maximum of 75,000 or 1/3 of assessable income. Okay, they have done the 100,000 worth of donations, and you have to look at both 75,000 or 1/3 of assessable income. 1/3 of assessable income would be 58,083. It is, that would be the approved charity donations. So in that case, taxable income would be 116,167. The applicable tax rate would be for the clubs is 10%. Okay, so that the Looney Cricket Club need to pay tax on 11,670 because the tax rate is 10%. Okay. Because this one is, the question is that 100,000 or 75,000, it is not the, because you have to check 1/3 of the assessable income or 75,000, whichever is lower would be the claimable qualifying payments. So for this, this is approved charity, you have to, you can claim only if it is made in terms of what? No. You can claim sick and needy people, I am agreeing, but for the especially for the approved charity, sick and needy people, you can claim these qualifying payments under the tax liability. As a qualifying payment, it should be made in money, not in kinds. Because we have done this claim because it is included in the income and expenditure account, it is purely made under the cash outflow. That's why we have took this here. Okay, so if it is not, even though it is 100,000, you cannot claim. But in terms for the government, you can totally claim this 100,000 and even carry it forward for the next year of assessment as well. For this approved charity, the balance amount, it is around 42,000 worth of, so you cannot carry it forward to next year of assessment. This year of assessment, so that that balance amount would be a loss to the company or the cricket club. Okay, so these are the things I want to highlight under the clubs, because for your final exam, either trade association, club or charitable institution, out of only one question will be there. Okay, not all. Okay, so you have to keep in your mind regarding the for the clubs. So it is tax under the body of person. So we have to first look at whether that club has been carried out the business during the year of assessment or not. So in that case, you have to calculate, identify the receipt from members and calculate the percentage out of the total receipts of that particular club. If it is less than 75%, we decide it as it is carrying out the business during the year of assessment. If so, club is liable to pay income tax, both the investment income and the business income. If that percentage is more than 75%, so that means the club has not carrying out the business during the year of assessment. So in that case, they are liable to pay tax only on investment income. Okay, so when you are calculating the business income, same applications you have to consider for the company tax, tax calculation, for the individual tax calculation even. So same source, that is the trade, business, profession or vocation. That source you have to refer to calculate the business income for here as well. Okay, so that is about what clubs. Then we go for trade association. Okay. So the trade association founded and funded by business that operate in a specific industry. That means it's a collaboration of the different companies for the development and their bargaining powers. They are going to establish different trade unions. Okay, so they are registered, it may be a registered one, so that the members are the business entities, but clubs, it may be even the individuals. So the trade association is chargeable for income tax as like in the club as well. We are going to classify it as a body of person under the charging section of the Inland Revenue Act. The provision on residential status of trade association is similar to that of company in terms of section 79 subsection 1 of the Act. That means same application goes for the clubs and the trade association. So here again, for the trade association, we are going to pay the income tax on business income as well as the investment income. Okay. When a body of person, whether incorporate or otherwise carrying on a trade association, chamber of commerce or similar institution, income tax liability to be decided as follows. Again, you have to decide whether that trade association carried out the business during the year of assessment or not. First step is to decide whether trade association or similar institution carrying on a business or not. In deciding whether a trade association is carrying on a business or not, receipt from members by way of entrance fees and subscription is the main criteria. Again, you have to calculate the percentage. When receipt from members are more than half of its gross receipts on revenue account including entrance fees and subscription, such trade association is carrying on a business. Okay, that means it should be 50% of more than 50% of the gross receipts. Okay. Trade association is deemed to be carrying on a whole of income arising from transaction with both members and others is deemed to be receipt from members. So that when trade association is deemed to be carrying on a business, income tax liability will be based on either profit from business or other income of trade association, whichever is higher. First you have to decide whether the trade association carrying out the business during the year of assessment, that means it's based on the receipt from members. It should be 50% of its gross receipts on revenue account, and if it is more than that, we decide the trade association carrying on a business during that year of assessment. Okay. If it is carrying on a business during the year of assessment, we have to consider both business income and other income. Out of that, which income source is higher, that would be the income tax liable source, not both. When a trade association is deemed not carrying on a business, only other income of trade association will be liable to income tax. If it is that percentage is less than 50%, that means trade association is not carrying on a business. So in that case, we have to pay taxes only on the investment income. If the trade association carrying on a business during the year of assessment, you have to calculate both business income and investment income. Which one is higher will be liable to pay tax. Okay. Take this one. So in that case, opening balance is there, sum of the closing balance is there. So income and the expenditure as well. So you have to first decide what? Whether that club has carrying on a business or not. So can you decide whether What would be the decision? Like in the club? What would be the percentage? What would be the percentage? Okay, first we are going to identify the percentage. So before that you have to identify the receipt from members. It is around 393,000 because the entrance fee, subscription, donation from members, it is 393,000, and then total receipt is 751. So 393 would be the receipt from members, and it should be half of would be 375,500, so that actual receipt is more than 50% of the total receipts. So what would your decision? The trade association carrying out the business during the year of assessment. If so, you have to pay taxes on what? Business income or other income, whichever is higher. So you have to calculate what first? The business income. Can you calculate the business income for that trade association? Okay, what would be the profit? Business profit. $122,000. Okay, the profit based on the cash differences 320,000 would be the accounting terms. Then you have to again the same application, no any difference. So disallowable expenses you have to add back and allowable expenses you have to deduct it. Okay, disallowable expenses, donations 69,000 cash donation is there. Rate 6,000 because it has a rent income. Definitely it has been paid for the rent income. Then entertainment is not allowed. 38,000 you have to add back. And purchase of computer it is not allowed to deduct. So 90,000 you have to add back. Then donation from members and donation from non-members, those are non-business receipts. So you cannot consider it as a business income. You have to identify the eliminate from the profit because it is already add to the profit. Then dividend income 90,000 and interest income 10,000. Rent income what 120,000 are different sources of income. It is not relating to the business income. Then finally, you have to give the capital allowances for the furniture. What would be the rate? 20%. Okay. So that 18,000 would be the capital allowances for that particular period. So if I am correct, it is 122,000. Please check that one. Okay, so that would be the business income. Then you have to calculate the investment income or the other income. In this case, three investment income are there: interest income, dividend income and rent income. Okay. Interest income is 10,000 and dividend income is 90,000 because it has mentioned that it is gross income, not the net income. If it is net, you have to convert it to the gross amount. Then rent income is 85,500. How it has come? Gross rent received 120,000. The rates paid 6,000, so that net rent would be 14,000. So net rent rate income would be 85,500. I will ask a simple question. In order to take this 85,500, there should be a criteria. That criteria should be satisfied. What is that? Under the property income, I think I myself have discussed those things. In order to take this rent income, because it is actually this is not the rent income, it is a net rent, not the rent income. Okay, this is a net rent. So in order to take this net rent as a rent income, you have to compare this with what? NAV of the house. If the NAV of the house is less than this net rent, then we are going to take it as a rent income. So at the moment you are going to assume that the NAV of this property is less than this net rent. Okay. So that our total investment income is 185,500 and the business income would be 120,000, 22,000. So what is our decision now? What is our decision now? For this trade association? on what we are going to tax, because this trade association carrying out the business during that year of assessment, because the receipt is the receipt from members is greater than 50%. So in that case, we assume that the trade association carrying out the business. If so, you have to calculate both business income and investment income. Out of that, the higher amount we are going to pay the tax. So the investment income would be the higher amount. Now can you calculate the tax payable by that particular trade association? So you have to pay the tax only on 185,500, not 120,000 altogether, because we are going to focus only the highest amount. You are going to just eliminate 120,000 worth of profit. So what would be the tax payable by that particular trade association? Okay. Total statutory income would be 185,500. So again, we have to calculate the assessable income. For calculate the assessable income, there is no income not form part of assessable income, because there is no withholding tax deducted income. If so, you have to eliminate those things. And deduction under section 32, no any losses or annuities or interest or any pre-commencement expenses. So nil. Then you are going to claim the qualifying payments, because they have done 69,000 donations. Okay, so you can claim either 75,000 or 1/3 of assessable income. So 1/3 of assessable income would be 61,833. So that would be the claimable amount. So that taxable income would be 123,667. Again, the tax rate would be 10%. So that 12,367 would be the income tax payable by that particular trade association. Okay, so this is about the trade association. So you have to keep in your mind. Let's assume that in that particular trade association, the gross receipt, when we compared with the total receipt, the percentage is 40%. What will happen now? Earlier it is around 52,000. Now it is 42. What will happen? You have to pay taxes only on the investment income, because in that case we assume that the trade association does not carrying on a business, because the percentage is 42, it is below 50,000. So in that case you need not to calculate the business income, but only the investment income you have to calculate. Straight away you have to decide what would be the income tax payable. So earlier the club as well, the percentage is less than or greater than 75,000. You have to accordingly you have to calculate it. So for the trade association, it is the decision criteria would be 50%. So just we have a small break. and we'll continue. Okay. Okay, come back to the session. The last one is charitable institutions. A charitable institution generally is a type of non-profit organization because we normally believe that it is not a profit-oriented institution. It differs from other type of non-profit organizations in that it centers on non-profit and philanthropic goals as well as the social well-being. The main focus is for the philanthropic and the social well-being. Because normally charitable institutions, they are engaging with the charitable, educational, religious and other activities serving the public interest or for a government goal. This would be their main activities. So it is not the business purpose. They mainly focus on the philanthropic and the social well-being. Okay. So first we define what we mean by the charitable institution. Section 217 mention provides the definition for phrase charitable institution. Charitable institution means the following persons established for a charitable purpose only or engaged solely in carrying out charitable purposes. So these persons involved with the charitable activities, we call it as a charitable institution, trustees or trustee or of a trust or corporation or unincorporated body of persons. So therefore it is noted that the charitable institution should be a trustee, a corporate body or even are solely engaged in the charitable institutions. Okay, even the trustees or corporated institutions or unincorporated institutions, they may be act as the charitable institutions. Their main focus is for the philanthropic and the social well-being. So these are the purposes which we can establish the charitable institutions. Charitable purpose means the purpose for the benefit of public or any section of the public in or outside Sri Lanka of any of following categories. Or it may be within Sri Lanka or the beneficiaries may be in outside Sri Lanka. The relief of poverty. Okay. The advancement of education or knowledge other than by any institution established for the business purposes or any institution established under the Companies Act. Some charitable institutions are there, they are focusing on the education, advancement of the education or knowledge, but the private institutions established for this enhancement of the advancements of the education and the knowledge, it is not related to the charitable institutions because it is incorporated under the Companies Act. It is purely for the business purpose. Activities for protection of the environment or eco-friendly activities. The advancement of religion or the maintenance of religious rites and practices or administration of place of worship, public worships. That means their main focus on the advancement of the religious activities. Any other purpose beneficial of interest to mankind not falling within any of the preceding categories. Any other benefits for the human as a charitable or the philanthropic or the social well-being apart from these previous activities. So it is purely for the charitable purpose. So that you have to keep in your mind. So when you identify it as charitable institutions, whether they have incorporated to achieve these kind of purposes. Charitability of income tax. So charitable institution is a person under the act. It is liable for income tax on any profits or income unless such profits or income are exempted from income tax, especially for the charitable institutions. Lot of income are exempted. Okay. The other, the income which are not exempted, we have to pay the income tax. Through a body, a corporate should be a charitable institution in terms of section 68 of the Act. The rules applicable to a company shall not apply such charitable institutions. For the company's tax provisions will not be applied for these charitable institutions even it is incorporated. Now we are going to compute the income taxes for the charitable institutions. So YMBA, likewise, these are the mainly the charitable institutions. So that first you have to look at the different sources of income of that particular charitable institution. So the taxable profits and income are to be aggregated for the calculation of the income tax liability. So that in that case, like what clubs and the trade associations, we are not going to identify the decision criteria because it is only for the purely for the philanthropic or the social well-being. In that case, we are not looking at whether it has been done the business activities or not. So straight away you are going to take the taxable profits. You have to keep in your mind different exempted profits as well. So you have to screen out the taxable profits only for that particular charitable institution. Then assessable income. When you are calculating the assessable income, these are the common things. So you have to first look at income not form part of assessable income. Then deductions permitted under section 32 and business commencement expenses are there. So these things you can deduct when you are arriving the assessable income. Income which does not part of assessable income. Following income sources are considered as income which does not form part of assessable income of a charitable institution, wherever applicable. So these are the income not form part of assessable income. Interest income subject to withholding tax under section 133. Interest income under section 35, that is deals with what? Section 135 means the corporate debt securities, and dividend income subject to withholding tax under 10%, section 75. Reward or share of fine subject to 10% under section 157. Lottery prize winning and gambling, interest on compensation, and profit from sale of gem. These are the, if withholding tax has been deducted, so these things are, we are going to classify it as a income not form part of assessable income. So that after that you are going to calculate what taxable income. When you are calculating the taxable income, you have to deduct section 32. It should be annuities and the interest. It should be eliminated, ground rent and royalties, and loss of trade, business, profession or vocation. These things should be eliminated. Okay. Then taxable income, I have mentioned that for the individuals and the charitable institutions, they can claim that statutory allowance of tax relief allowance of 500,000, and then you can claim the qualifying payments as a charitable institution. So you have studied section 34, list of qualifying payments. Those things are as well applicable for the charitable institutions. So applicable rate would be again 10%. No need clubs, trade associations, charitable institution, the fixed rate of 10% you have to keep in your mind. And then this, when you are calculating the tax of the charitable institutions, you have to, when you are calculating the total statutory income, you have to take only the taxable income. So that means there are a lot of exemptions because it is purely for the social well-being and the philanthropic purpose. So Inland Revenue Act itself provides lot of exemptions for the charitable institutions. So income tax of a charitable institution is computed after considering the exemptions provided in the Act. The first one would be the net annual value. Because under the property income, if you can remember, I have discussed the place of worship. So it would be net annual value would be exempted, because in the previous slide I have mentioned that the charitable purpose, the advancement of the religious activities. So that if any public worship premises are there, the net annual value would be exempted. So that under the property income, no taxes they are going to liable. The net annual value for the following are exempt from the income tax: any place of public worship and its premises administered by the charitable institution. Okay, so it may be a church, mosque, whatever the thing, temple. So the net annual value would be exempted. Any place of premises owned and occupied by the institution solely for any of the purposes of the institutions. YMB, they are the wholes, it is only purely if they are going to use for the institution purposes, for the well-being or the philanthropic purposes. Again, these premises, apart from these public worship places, the net annual value would be exempted. But they have run it for the renting purpose, then it is not exempted. Then interest, the first one would be the NAV, the exemptions. The second one is the interest on institutions providing care for the children, elderly and disabled. Okay. Okay, some of the institutions may be there, they are providing the care of the children and the elderly, homes and the disabled. Okay, those institutions as well we are going to classify as the charitable institutions. Interest occurring in any year of assessment which is proved to be satisfied to the Commissioner General in relation to that year of assessment of such interest is applied solely for the purpose of providing care for children, the elderly or the disabled in a home maintained by the charitable institution is exempted from income tax. Elders' home, because these charitable institutions, they are going to maintain some of the hostels or the elderly homes. So if that deposit interest, if that institution can prove that this interest income for the year of assessment is used purely for these caring activities, that interest would be exempted from income tax. That means that charitable institution is not liable to pay income tax on that interest income. So in that case, that institution should have to prove that this interest is applied solely for this caring services for the children, elders and the disabled people. If so, again the interest income will not be taxed. Profit and income from property donated prior to 2nd March 1825 in royal period. The profit and income from any property donated by royal or other grant before 2nd March 1850 to any place of public worship administered by the institution insofar such profits and income applied to the purposes for which such grant was made is exempted from income tax. Okay, that property donations should be prior to 1850. So, in that case, these profits and income relating to that particular property vested to that institution is exempted from income tax. Offertory subscriptions and the donations received by the charitable institutions are not liable to tax. Okay, that means donations received by the charitable institutions. Now, up to now, you have made the donations as an individual, as a company, as a trade association, as a club. You have made the donations. Now, you are receiving the as a club, sorry, charitable institution. Now, we are receiving the donations. Okay, if you have received the donations, these donations, it is a receipt. It is an income, but it is not subject to income tax. Whatever the offertories and the subscriptions and the donations, all the things are exempted from income tax. Okay. Normally offertories means we call in Sinhala the sammada. Okay. So these things are not taxable. Where a charitable institutions provide care for the sick and needy and is able to satisfy the Commissioner General that the cost of such care is borne by such institution, the tax payable could be reduced or remitted at the discretion of the Commissioner General. Okay. That means any charitable institutions, they are dealing with the care for sick and needy people. Okay. So, it is sick and needy people, that means normally the applicable rate would be 10%. Okay. That the institutions where they are providing care for sick and needy people, they can specially write to the Commissioner General. So, we are purely providing this kind of services. So, to request the reduce the tax rate by 10% to 8% or whatever the rate, the suitable rate, they can write it to the Commissioner General. They can get the discretions or the directions. Okay, purely the institutions where they are dealing with only for the care for sick and needy people. Okay, that is related to the to reduce the tax rate. So these things are the things you have to be considered when you are calculating the income tax payable by the charitable institutions. So this would be the example. Sadham Sis's Foundation, which was established in year 2005, is a religious organization. That means they have incorporated in order to promote the religious activities. One of the charitable purposes. Main object of the foundation is advancement of religious or maintenance of the religious rites and practices. Hence, the foundation is the approved charity status. So, charity is classified as an approved charity. Secretary of the foundation has prepared the income and expenditure statement for year ended 31st March 2016. The surplus for the period ended was 8 million. Following income and expenditure have been considered in arriving at the surpluses. Okay, so that bank interest, debt amount 184,000, profit from cafeteria, public donations, sammadam, offertories, net Dividend 90,000, gross rents 360,000. The expenditure side, rate paid on rented property 60,000, purchase of computers for cafeteria 100,000, ground rent paid for premises for the foundation 600,000. In addition to the above, following information have also been provided by the manager of the foundation. Foundation has 3 houses. One house is given on rent. The other 2 houses were used for the staff of the foundation. Rating assessment of houses were 600,000 and the 800,000 respectively. So, compute the statutory assessable taxable income and tax payable for the period. Compute the exempt income and the income which is not part of assessable income. Okay. So, this charitable institution is simply you can consider it as the individual tax calculation. Same things will be applied apart from that special exemptions. Okay. So, first look at each source. Okay. Bank interest net. Is it a taxable one or exempted one? It is taxable. So, here the net amount is 184,000, but you have to take the gross amount. So, what would be the applicable withholding tax rate? Because in order to convert into the gross amount, you have to have the applicable withholding tax rate. What is the applicable withholding tax rate for this Sadham Sicilasa? Nothing given, but you have to have an idea what would be the applicable withholding tax rate for this bank interest. 2.5%. Yeah, correct. 2.5%, and of 2.5% would be the 184,000. So, you have to cross it up. Okay. Then profit from cafeteria, earlier it is 8%. But now after 2015 and 16 it is 2.5%. Profit from cafeteria, it is their business activities to generate the revenue. So, it is liable. So, you have to make some adjustments in order to convert it to the tax adjusted profit, because it is related to which source of income? Profit from cafeteria. Which source of income up to now you have studied? Profit from trade, business, profession or vocation. So, that you have to clearly identify the section 25 and section 26 applications for this profit from cafeteria. And public donations, is it liable to pay taxes for the charitable institutions, because it is an income to the charitable institution. Now, you have received 800,000 worth of donations from the other institutions and the individuals. So, is it liable to pay taxes on that 800,000? No. For the charitable institutions, public donations are exempted from income tax. So, for the second question is the one exempted income would be this public donations. Then some other. Again it is offertories are exempted, no need to pay the taxes. And dividend net. That means they have already paid the taxes, withholding tax. What would be the applicable tax rate? 10%. Yeah, 10%, because now it is 90, so it would be the 100,000. So, it is part of the total statutory income. Then gross rent, taxable under which source of income? Property income. So, as it is, can we take 360,000 in order to calculate the taxable income? Are we going to take this 360,000 as it is? No, you have to calculate the net rent and you have to compare it with what NAV, then decide what would be the rent income. So, can you calculate the gross rent? Because at the moment all the things you have considered, can you calculate the gross rent? Sorry, the rent income based on the gross rent. Gross rent is 360,000. So, in order to calculate the rent income, what you have to do? You have to deduct what? Rates, then you have to claim 25% on the repair. So what would be the total net rent amount? Rates paid on rented property is 60,000. Is it not a percentage? As a way, that means net of 300,000, 360,000 would be the gross rent received. From that you have to deduct rate paid 60,000, that is 300,000, 25% on the repair 75,000, then means 225,000 would be the net rent. In that case, you have to assume that NAV of the house, because on the last point, they have given the rating assessment for the other two houses but not the rented house. So, in that case you have to assume that NAV of the house is less than that 225,000. So, that rent income would be 225,000. Okay. Then purchase of computers for cafeteria. This side would be the expenditure side. Okay, purchase of computer, profit from cafeteria would be 2.1 million. That means from that, because they are having just income and expenditure account, so if they have deducted this 100,000 when they arrive in the 2.1 million, so they have to just add back this 100,000, then you have to claim what? On computers capital allowances, what would be the percentage? 25%. That means 25,000 they can claim. Ground rent paid for premises for the foundation. It is allowable. Okay, 600,000 ground rent are allowable. Because now ground rent you can deduct when you arrive in the profits. Then in addition to the above, following information have also been provided by the manager of the foundation. So it has three houses. One is given on a rent, already we have calculated the net rent. Other two houses, they are used it for the foundation stuff. That means in order to carry out their foundation activities. So rating assessment of the houses was 600 and 800,000 respectively. What will happen now? What will happen now? Any idea? Under the exemptions, we have discussed that net annual value exemptions. Okay, any public worship places and place of premises owned and occupied by the institution solely for any of the purposes of the institution. That means the balance two houses, are they going to use their foundation purpose or any other purpose? Their foundation purpose. So that exempted but not two. Which one is higher will be exempted. Highest NAV carrying activities will be exempted. So that how we are going to calculate the NAV? How are we going to calculate the NAV? So 600,000 minus 25% and 800,000 minus 25%. So the highest one would be exempted. Okay. So according to that, they have to pay the taxes on which? Profit on cafeteria and the gross rate. And but in total statutory income, they are having the bank interest, dividend income, and what profit from cafeteria and the gross rate. That means the net rate. Okay. So that would be the total statutory income. Then again you have to deduct what? That is the total statutory income, because exempted profit are the income are donations and the offertories. Okay, these two things, 800,000 and the 900,000, is not liable to pay taxes. Those are exempted. Then other business bank interest, profit from cafeteria, dividend and the gross rate, that would be the total statutory income. From that you have to arrive at assessable income. When you arrive in the assessable income, you have to deduct what? Two things you have to be considered. What are those? Income not form part of assessable income. If there is so in the total statutory income, you have to deduct. Is there any income not form part of assessable income here? Dividend and the bank interest. Okay. So you have to eliminate the two figures, gross figures. And is there any the section 32 deductions here? In this simple example, is there any 32 deductions? Any interest payment or annuities or losses? No. Okay. Then assessable income. And after when you are calculating the taxable income, what will happen now? For the charitable institutions, first you can claim what? Tax-free allowance, 500,000. Now you can claim, but clubs and the trade associations, they cannot claim that tax-free allowance, but individuals, resident individuals and the resident charitable institutions, they can claim this 500,000. Then after that, qualifying payments. Okay. So that applicable tax rate would be how much? 10%. If you want, if you are providing care for sick and needy people, you can get the directions from the Commissioner General to reduce that tax rate. But commonly applicable rate would be 10%. Okay. So I am not going to provide the answer here. Okay. You have to just calculate, but I will upload the answer. And taxable income, tax payable by the period would be at a rate of 10%. So compute the exempted income. What would be the total exempted income? Offertories, public donations and the NAV of the one house is exempted. Okay, all three are exempted. And income not form part of assessable income, how much? Dividend income and interest income. So for your examination purpose, you will not receive as that much simple question, but to elaborate the points, because I am going to select only one question out of these three areas. Okay, either it would be club, trade association or charitable institution, not all three. So that because simple difference is there, because if it is state club, the difference would be the decision criteria, it is 75. Okay, if it is 75, less than 75, that means we are carrying out the business. So in that case, both we have to pay the taxes. If not, you have to pay only on the investment income. It becomes trade association, decision criteria would be 50%. If it is more than 50%, that means they are carrying out the business. The other way around. So that you have to pay the income tax on which one is higher, not both. If they are not carrying out the business, only on the investment income. For both three institutions, the applicable rate would be 10%. No any difference. Especially for these charitable institutions, some of the exemptions are there, especially because it is different purposes are there, the philanthropic and the social well-being in that case. So they can claim lot of exemptions on their receipts. So you have to, in any case, if we receive the question on a charitable institution, you have to keen on whether that receipt is exempted one or taxable one. If it is exempted one, you have to just ignore to calculate the total statutory income. If so, if you consider that one as a taxable income, totally it is incorrect. Okay, so you have to clearly identify. I have clearly mentioned the different exempted things under one main heading. NAV, special interest income for the elderly and child and disabled persons, the interest income will be totally exempted. And what property vested donated prior to 1815, total income would be exempted. Okay, offertories, subscriptions and the donations received to the charitable institution totally exempted, and even you can reduce the tax rate if we can get the directions, you can pay a less tax payable. Okay, those things you have to be keep in your mind when you are calculating the taxable income, especially what charitable institutions. You can claim tax-free allowance of 500,000, but other two things they cannot claim that 500,000. That is trade associations and the clubs. Okay, those are the differences in these three areas. Okay, so these things I need to be mentioned. So is there any queries? Up to now, I think now we are in 12th week.